Hi, everyone. Thanks for joining us a little bit early. We're going to get started with the program at the top of the hour as promised in about 5 minutes. I know some of you have joined us a little early, so I wanted to reward you with some insider tips on how to make the most of the program, and then we'll get a few personal insights into our speakers, and then we'll start the formal program. So in terms of making the most of the webinar, we do have handouts that you can access from the control panel. We have slides from Nadim Malik's presentation that you can download. And we also have a report of a survey that we did of best practices in business development that was based on a survey from last year. So avail yourself of those resources. Also, feel free to ask questions now or at any time during the program, anything that you want to get answered. And you can also do that through the question feature of your control panel. Okay, so I'm David Toll. I'm founder of Private Equity Career. I'll be your impresario today. And I'm super excited to have our cast of speakers and experts. Let's find out a little bit more about them and how they spend their, particularly how they spend their spare time. Steve Hunter, TM Capital, let's start with you. What's a passion you pursue outside of work?
Oh, let's see. That's a good question. I've got 2 kids that just graduated college and one heading off to college. So this summer's been more about shuttling people around and moving things than having much fun. But I would say I'm at a point where I'm starting to play a little bit more golf and hoping to maybe shave a few strokes off of my poor handicap. And then I've also gotten quite a bit more into boating the last couple of years. So spend a lot of time down on the Georgia, South Carolina coast, boating all around down there. So I'd say that's probably the two things that if I had some free time, I would like to be doing.
Very cool. Ram Goodrich, tell us how you spend your spare time.
Same thing, trying to when and if I can get out of the office, it certainly is trying to chase a little white ball around. A good walk ruined, yeah, certainly for sure, but not doing it quite as much as I want to, but more than my wife thinks I should. So I think that's probably the happy balance. And then, like Steve, I've got 2 kids, one in college, one out of college. It's been really fun having them home. My college graduate is still pursuing her next career move. And so we've got lots of free time at home these days, but it's fun to have her home while she can.
Thanks, Ram. And Ted Kramer, tell us a little bit about what you do outside of work.
Yeah, good question. I think I travel so much. We still like to travel personally. So either my wife and I will do some traveling or with our kids, but I think we're all in the same boat of transitioning our kids into college. So trying to spend as much time with the family as possible. Like all of us on the panel, I still enjoy playing golf and don't feel guilty as much anymore having to go out and play golf. It's a therapeutic exercise for me, and enjoy kibitzing with others out on the golf course.
Okay, thanks, Ted. And Nadim Malik, SBS by Bain. Nadim, how do you spend your spare time outside of work?
I'm happy to say that I do have hobbies that I enjoy. If you asked me 10 years ago when I was building up SPS, I didn't even know who was playing in the Super Bowl or anything like that. But and I'm also, I guess I shouldn't be surprised. I'm not very unique. I have my oldest going off to college. I have a 16-year-old who just got her driver's permit, so I'll be teaching how to drive along with professional drivers. And yeah, I love golf. I also love to travel for fun, and I play the guitar a little bit. So that's something I started as an adult about 10 years ago when my son started taking lessons. I thought it would be something cool we could do together, and we just kept it going. So I'm happy to say every now and then I like to play the guitar.
All right. Well, thanks to those of you who came a little early and got some insights into how our speakers spend their time outside of work. And now let's get started with the formal program. Good morning and welcome to a special private equity career news webinar. Our topic today is how to prepare for the next wave of big deals. My name is David Toll. I'm the founder and publisher of Private Equity Career News. I'm going to be your moderator for the program. I'd like to start out thanking our sponsor, SBS by Bain & Company. They've been a terrific supporter. They're an award-winning provider of actionable data and analytics for private equity firms seeking to optimize their deal sourcing efforts. A few housekeeping announcements before we kick things off. First, a friendly reminder to any reporters on the program today that we are off the record. Please reach out to the speakers individually for permission if you would like to use anything that they say in an article today. Second, you can download a copy of the slides from today's program. You can do that from your control panel. You can also download a copy of the results of a 2023 survey of business development professionals. It includes some valuable information on industry practices. Third, later today, I will send you a recording of the program, so no need to take extensive notes. And finally, many of you asked really good questions of our panelists when you registered for the program. We will plan to address those during the discussion portion. Please also feel free to ask questions at any time during the program. You can do that through the question feature on your control panel. Okay, that's housekeeping stuff, and I'm super excited to have 4 expert speakers today to guide you through our topic. We have Ram Goodrich. Ram is based in Southport, Connecticut. He is managing partner at investment bank Carter, Morse and Goodrich. We have Steve Hunter. He is based in Atlanta. He's managing director of investment bank TM Capital. We have Ted Kramer, Indianapolis-based CEO and partner at buyout firm HKW. And we have Nadim Malik, founder and CEO of SBS by Bain & Company, based in New York City. After introductions, Nadim will present statistics describing the state of the M&A market, and he's also going to address the role that technology plays in helping deal originators see a higher percentage of relevant transactions in their sweet spot. Okay, with that, let's find out a little bit more detail about our speakers. Ram, let's start with you. Tell us a little bit more about Carter, Morse, and Goodrich, your role there, and also what's behind you in that window view. Go ahead.
Thanks, and I'm thrilled to be here, so thank you for including me. Yeah, I would love to say that's a virtual background, but it's actually not. It's a tributary, the Mill River, ending up in Long Island Sound. And this spit of land right behind me is actually the Country Club of Fairfield, which is one of the top 100 golf courses. So anybody needs to come play that, certainly give me a buzz. We can figure something out. So, but I'm Ramsey Goodrich, Carter Morse. We are for 37 years, we've been a boutique investment bank specifically designed for families and founders. Our real specialization is working with multi-generational family businesses on their once-in-a-lifetime transaction. Generally speaking, in the $50 to $150 million range is our sweet spot. For certain special companies, we might go down a little further than that. We love doing larger deals than that. We've got a 300 and about a 450 deal going on right now. So, but we love that entrepreneurial spirit, that owner-operator who's going to do it once in their lifetime and really wants to they value really good advice and are willing to invest in their success. And we'll get into more of what that means later, but thrilled to be here. So thanks, David, for having us.
Thanks for being here, Ram. And Steve Hunter, let's turn to you, other investment banker on the panel.
Thanks, David. Appreciate you including me on this today. I'm Steve Hunter. I'm a managing director at TM Capital. We are not quite as old as Ramsey's firm. We've been around 35 years. We also specialize in transactions sort of between 50 million of enterprise value up to 200. We also like doing bigger deals, and we'll do a couple bigger deals each year. But most of what we're doing is sort of in the 50 to 200 range. We normally do sort of 25 to 30 deals a year. pretty spread across industrials, consumer, business services, chemicals, and healthcare. Our deals are split pretty evenly between deals for founders and deals for sponsors. I actually lead our private equity coverage effort, trying to sort of help grow the sponsor side of our business. TM was acquired by Janney Montgomery Scott at the very end of last year. Janney's a 200-year-old financial services firm based in Philadelphia. And then in a bit of a surprise, Janney itself was acquired by KKR yesterday morning. And so we don't quite know what that means for us yet, but it's exciting times.
I think it means more business from KKR.
We're hoping so. We think they could keep us pretty busy.
I bet.
That's awesome. I don't know how I missed that news, but
I missed it too.
good.
Congratulations.
Yeah, that's great. And Ted, tell us more about yourself and HKW.
Yeah, I'm not sure how to compete with Steve on that one. You know, having Kennedy Whitney, thanks David and Nadim for including HKW today. It's great to be here with two old friends I've known for a long time. But, you know, HKW is a firm that was founded in New York in 1903. Very similar to Stephen Ramsey, was an investment bank, merchant bank till about 1982. And then the firm moved or evolved into a change of control private equity firm. We were finishing investing out of our fifth fund. And what we do are very similar to the clients that Steve and Ramsey have described, mostly founder-owned businesses tied in through manufacturing, distribution, some tech-enabled and service-related companies, typically in the $5 to $25 million EBITDA line. We do still have an office in New York, obviously, and our main office is in Indianapolis, Indiana. And currently we are partnered with 15 portfolio companies in our firm.
Super, thanks for doing the program, Ted. And now let me turn the baton over to Nadim. And Nadim will introduce himself and also present some data to shed light on the current state of the M&A market. Nadim?
Thank you, David. Thank you to our fellow panelists, and thank you to the audience for joining us today. Looking forward to a nice panel. My name's Nadim. I'm founder and CEO of SPS by Bain & Company. We're continuing to work with our clients to help position them for relevant deal sourcing opportunities in the current or any market using data, analytics, technology, and automation. Well, deal activity in the private equity and M&A world continues to steadily rise, as we'll see in some of our data in our discussion today. Though I think it's fair to say not to the extent people were expecting in 2024. But are we now on that cusp of that long anticipated surge of deal activity? How important are things like interest rates and election results to that equation? Well, I'm really looking forward to hearing the perspectives of our panelists. They're great at what they do. They've been doing it for a while, each of them grappling with many of the same questions as our audience. But before turning things over to them, I wanted to spend the next 8 to 10 minutes walking through some slides to help frame our conversation, starting with the one that you see in front of you right now, which is total private equity and M&A volume. The dust is pretty much completely settled on 2023 full year data, and it looks like deal activity declined by about 16% last year. As a reminder, despite that decline, deal activity came in at the third highest level we've ever seen since we began tracking the data. I'll also point out that the first half 2024 deal volume is on pace with 2023 levels, with deals completed in the first half of the year at just under 50% of total volume for last year. And finally, private equity buyers have narrowly outpaced corporate buyers so far this year, completing 51% of deals compared to 53% last year. Moving on to the next slide, let's look at the quarterly closed deal activity and see what kind of trends we can glean from that. I find this a chart or breakdown to be fascinating. You can see the climb from the base of the mountain, as I like to call it, starting in Q2 2020, which is the peak of COVID. You can see how deal activity fell pretty dramatically then, but you see that climb consistently up to the summit in Q4 2021, with its peak, and then the downhill trend since then, until Q4 2023, which was up compared to Q3 2023, breaking a 7 quarter-over-quarter down deal activity streak. And now that the picture on Q1 deal volume is more complete, we can see that activity in Q1 was slightly higher than Q1 2023, which is an encouraging trend. Also, Q2 numbers, once the data lag effect is behind us, will come in higher than Q2 last year as well, suggesting a positive trend shaping up year over year for 2024 deal volume. My final comment on this slide is that if you look at the last 6 quarters, you can see how much deal activity has essentially stabilized when compared to like the prior couple of years, prior to that. Moving on to the next slide. This is a look at the most active sectors for the first half of 2024 compared to 2023, broken out between strategic and PE deals. Industrials has been the most active sector and is up slightly compared to last year, followed by technology, business services, and consumer, which are also up. Interestingly, healthcare, financial services, energy, and media telecom are all down for the first half of 2024 compared to last year. Also, PE has the edge over corporate buyers in all of the top 5 most active verticals, while the financial services, energy, and media and telecom sectors still tend to have a higher share of strategic versus PE deals, though the financial services sector had slightly more PE deals than corporate deals in the first half of 2024, which is a new trend. Moving on to the next slide. This shows a breakdown of larger transactions of over $1 billion into more granular size categories, which tend to get compressed in other charts due to the prominence of smaller deals. Deal activity on this end of the market has declined each year for the first half period since 2021, and both 23 and 24 half-year numbers were below the historical median. It's also worth noting that on this end of the market of larger transactions, corporate or strategic activity still outpaces PE deals considerably. Moving on to the next slide, which is very relevant for our discussion today and our panelists. The trend of the buy and build and roll-up strategies in private equity continues to accelerate and has reached 2.7 add-ons for every platform in the first half of 2024, compared to 2.5 add-ons for every platform last year and 1.4 add-ons per platform about a decade ago, so almost doubling in that time. It'll be really interesting to see how far this trend will continue. Are we going to surpass 3 add-ons for every buyout or 4 add-ons? I think it's really hard to ignore this trend if you're a PE firm, and we're certainly seeing an increasing focus on it on the deal sourcing side with our clients. Moving on to the next slide, let's look at private equity activity only. And let's break down the sectors by the 4 deal types we track, which are add-ons, buyouts, recaps, and financings, which we call non-change of control transactions. The industrials, business services, and financial services sectors saw the greatest add-on activity relative to other deal types in the first half of 2024, while financings continue to remain an important investment strategy in the technology space. The overall decline in healthcare PE activity in the first half of 2024 was driven by a sharp decrease in add-ons year over year. Nonetheless, add-ons comprise the biggest share, if not an outright majority, of all transaction types for most sectors, and are the key reason why PE activity represents a higher share versus corporate buyers of overall M&A activity for the last 3 years plus. Looking at the next slide, this shows the top 25 sell-side advisors active in the first half of the year in terms of number of deals, further breaking down that activity by size range. Houlihan, who has the top spot, has a pretty well-balanced cross-section of different deal size ranges they've completed so far this year. I would say the firm's generational equity and benchmark really stand out on the lower end of the market, which we call sub 50 million of EV, while JP Morgan, Goldman, and Centerview jump out on the upper end of the market. Moving on to the next slide. This shows private equity pipeline data, and it shows the median number of deals PE firms saw, or logged perhaps more accurately, in Q2 24 was 238, which is up significantly, over 18% from the prior quarter. It's also worth noting that Q2 24 deal flow was up almost 10% compared to Q2 2023. I'm starting to get an echo for some reason. Maybe I'll just say my fellow panelists just to put themselves on mute for now while I continue to talk, and then we can go off mute. Thank you. Yeah, it's gone now. That's much better. So it was up 16% from the prior quarter. It's also worth noting that Q2 24 deal flow was up almost 10% compared to Q2 23, which is a more relevant comparison. While these numbers can't speak for quality, it does suggest that deal flow is trending positively, purely from the perspective of volume, and I'm sure our panelists will want to chime in on that when we get into our discussion. The overall rise in deals seen by PE firms is very much in line with the steady rise in closed deal activity, and it doesn't always work that way on a one-to-one correlation, but it seems to be playing out in the data right now. Moving on to the next slide. Here we have an analysis that we publish annually in a series called The Science of Deal Sourcing 101. There's a lot going on here, so let me just walk everyone through this. The columns represent the median quarterly deal flow numbers similar to the prior slide that PE firms see on a quarterly basis. The line here represents the percentage of those deals launched in that quarter that actually end up trading. And they end up trading typically around 7 months, could be more, could be less on average, but 7 months on average down the road. If you're not familiar with this slide or related content or SPS in general, this percentage will come as a surprise. Indeed, only about 30 to 40% of deals PE firms see and log actually end up trading at all. And if you take a look, you can see how that percentage dips during COVID. This should lend credibility to the data. As we all know, a higher than typical share of deals that launched just prior or early part of COVID did not end up trading. But that percentage bounces back sharply for deals brought to market in the subsequent quarters, peaking in Q1 2021, only to dip again dramatically from late 21 through 2022 and into early 2023. Now, it's very possible that the percentages for these most recent quarters might get restated higher by the time we publish this again next year, if some of those deals end up closing. But the trend is very clear over the last few years of an increasing percentage of stalled processes or deals being brought to market and not closing. All of this points to the importance of staying on top of broken deals, something the SPS portal can be used for very effectively and something we've really focused on with our clients over the last couple of years. Moving on to the next slide, which is our final slide. This is a preview of our new annual sector report scheduled to come out next month. It's an addition to our current set of annual reports which we publish, which include the Private Equity Harvest Report, the Deal Origination Benchmark Report Statistics, or the Dober Benchmark Summary Stats and Analysis, and the PE Deal Data Book. The SPS Sector Report will consist of the latest deal activity trends per sector, providing a comprehensive snapshot of the industry's firms and investment strategies driving private equity deal activity. What makes this report special is that it's derived from the proprietary industry taxonomy developed by our parent Bain and adopted by SPS, which is very precise. It's 500 subsectors rich, and it's based on the decades of work Bain has done with private equity firms and M&A participants. So it's really based on how they look at the world. It's like nothing else out there that in the market that I've seen or am aware of. The report dives into our sector taxonomy to further evaluate key sectors that have experienced significant growth or disruption over recent years, revealing key emerging opportunities. It also shows a competitor analysis and some trends around relevant intermediaries in a client's target market. With that, I will turn it back to our moderator, Mr. David Toll, and our panelists for our discussion and Q&A. Thank you.
Okay, Nadim, thank you very much for going through the data. And I'd like to kick off the discussion portion of the program with a polling question. We've got a very large audience today, and it'd be nice to take advantage of that intelligence on the line. So I'd like everyone to ask or to answer, how do you expect the number of platform deals that you close in 2024 this year to compare with last year? So let me tee it up. So go ahead and answer. Your choices are down from last year, even with last year, up to 10% higher than last year, or more than 10% higher than last year. As soon as about 2/3 of you have voted, I will end the poll and show you the results. All right. Poll is closed. And so it looks like there's a little more optimism on this program than Nadim's first half report would suggest. So almost 1/3 of you expect the number of platform companies that you close this year to be up 10% higher than last year. So very interesting. And now let me ask a related question. And that is, given the importance of add-ons to today's market, how do you expect the number of add-on deals you close in 2024 to compare with last year? So go ahead and make your selections down from last year, even with last year, up to 10% higher than last year, or more than 10% higher than last year. Again, I'm going to wait for well over half of you to vote before closing the poll. Okay, I've closed the poll, and here are the results, which are very similar. So again, about 1/3 of you expect the number of add-ons that you do this year to be up to 10% higher than last year. And about 40% expect it to be even with last year. So very interesting. And we're already halfway through the year, so you have to figure these numbers are pretty telling. Okay, with that, I will indeed kick off the discussion portion of the program. And I have a question that I'd like each of my panelists to answer in turn, and that is just the overview question. What is the quantity and quality of deal flow like out there right now? Ram, as we speak, what are you seeing?
I always hate it when you start with me, but I'll do what I can here. Despite sort of the feelings in the marketplace, Nadim's slides prove that it's actually an active market right now. We're all saying, well, it's down, it's down, it's down from record highs. You know, so we've got to take this in context. If you go look back a few years, deal flow still remains steady. And if you really bifurcate that back down into the sort of our core market, the middle market, and take out the noise of the brokerage deals that are too small and the billion-dollar deals that we don't really deal with, it's always been steady. It always has been and always will be. You know, this is, and we've done presentations about this for years about the too much capital chasing too few deals. You know what? There's always an equilibrium in the middle market that is unlike anything else. With that said, I'm on your survey poll, I'm on the bottom there. I'm the guy that thinks we're going to face a tidal wave of transactions coming to market really quickly. Yes, private equity is adding to their portfolios, as the data suggests, but we haven't seen that the silver tsunami come in yet. Our focus is really on that family owner-operator business, right? If you go back in time over cycles, you had every economic cycle sort of gets sellers to sell again. And if you go back to the crash of '87, the '93 real estate bubble, plus 6 or 7 years came to 2001 tech bubble, plus 6 or 7 years came our financial crisis, plus 6 or 7 years your 2016. Anybody remember what happened in 2016? Nothing happened in 2016. So we missed that cycle of getting sellers to sell. So since 2016, what's happened? We were all fat, dumb, and happy. The stock market's rising up. Everybody's good. Low interest rate environment has been fantastic. COVID hit. Everybody sat back on the sidelines. Supply chain hit. Everyone sat on the sidelines again. Interest rates spiked. Everyone sat on the sidelines. Well, as soon as we get through this, I think you're going to see that silver tsunami. I think you're going to see the demographic and the psychographic of older baby boomers getting out of their businesses is about to hit. It's a tidal wave that is coming. I know we're ramping. We can't hire fast enough getting ready for this pending wave of private company sellers. Private equity is always there. They've been on the sidelines for a couple of years. You're going to add that into the mix here as well. And so I think where we sit right now, we're at a nice equilibrium, but I do see this wave coming in. We'll get to, in terms of quality, we've always heard that A companies are continuing to trade at premiums right now. That's certainly still true. But I think we're starting to see the folks really thinking about, okay, if I can pay up for an A company, or maybe I can pay a little less for a B company and fix it. And so I think you're starting to see folks look at more interesting type of transactions. And so I think you're going to continue to see that trend as more and more businesses come to. That will have an impact on valuation, by the way. You will see, I think, valuations retreat back down on the average because more B companies are going to be trading here fairly quickly. So does that answer your quality and quantity question, David? I'd love to hear what Steve has to say here too.
So I'm hearing us. Go ahead, Steve.
I was going to say, I think I agree. I think the you know, from just anecdotally on our end, we had our biggest pitch month this July of any month since May of last year. You know, and before that it was, you know, even further back, sort of in that crazy time frame of 21, 22. So I think we've seen, you know, we pitched deals in July that would be equivalent to maybe, you know, a quarter or a third of what we would do in a typical year. So I mean, it was a really big month for us, which just says there's a lot of stuff that people are thinking about bringing to market. You know, our overall level of activity, I'd say, continues to be at a good level, but it's still at a fraction of what it was back, you know, in 21, 22 when things were at crazy levels. I think the similar to what Ramsey was saying is I think we just need some stability. I think if we can get, now that interest rates have sort of been the same for a little while, I think if we can, you know, just have, you know, not have some crazy things going on, whether it's politically or geopolitically, just a little bit of stability. I think you're right. There's going to be a wave of things coming because of the age of these owners, private company owners. And on the private equity side, you know, the average age of a private equity portfolio company is creeping up on, you know, it's over 7 years at this point. And you know, all the stories you read are just about how LPs want liquidity. I'm sure Ted can talk to that some, but you know, and so I think there's finally like a reckoning that is coming where private equity firms realize, you know what, we may not make money on this deal, we may not have a gain on this deal, but we need to clear this out and make room for some new things. So I agree. I think we're starting to see the beginnings of the wave.
And Steve, when you look at the quality of the companies that you were pitching in July, is it consistent with what Ram was saying about more companies maybe in need of some fixing up and some improvements, more B-type companies? What did you see?
All of our clients are A companies, so they're all, you know, I'd sort of, I don't know, I think that's probably true. I think in general, I think in general, all of the quality probably is down a little bit. I mean, we hear that a lot from private equity firms that, you know, quantity is up and quality is down. I don't really I don't spend a lot of time talking about the quality of it, because our deal flow is our deal flow, and we'll find buyers for it, whether it's, we'd love to have all A companies, but unfortunately that's not, we sort of play the hand we're dealt. So if it's the nice thing I always tell clients when we're pitching businesses, there is a buyer out there for every business. It's just a matter of price and finding the right buyer. So, there are a lot of people that have been lined up to buy distressed assets for a number of years that haven't had anything to buy. There are people out there that want to target, super premium, high margin, recurring revenue businesses that, are always looking for things like that. And there's everything in the middle. So I think there are buyers out there for everything. The quality kind of is what it is, unless a business owner wants to really invest 2 or 3 years to try to really, polish his business before he brings it to market. I kind of view the quality just as sort of just a something that comes along for the ride.
Okay, Steve, thank you. And Ted, you're in the trenches doing deals as a sponsor.
It's a good
what
question.
do you say?
Yeah, I try to be additive to what Ramsey and Steve have added. I think, from an HKW perspective, again, small and middle market, mostly founder-owned companies, it's been choppy. I think the quantity, for most firms like ours and others who've got institutionalized sourcing models, there's always deals coming in from a myriad of, investment banks, intermediaries, referral sources. I think how I would try to segment that under is that whether, you're a large, medium, or small intermediary, for us, it's a lot of founder-owned companies. We don't see as many private equity portfolio companies in the market. Certainly we look at them. We have better success closing our founder-owned companies. But even at HKW, we're in discussions with their LPs about the point Steve brought up about when to exit these companies, and the risk benefit of getting companies out in the market earlier in lieu of maybe a higher return, and how does all that work? And you get different answers from all kinds of investors, which makes it hard for HKW and I think all of our peers and competitors how to sort their way through that. But from a quality perspective, I think it depends on sectors that Steve alluded to. It depends on generalist private equity funds versus sector-specific private equity funds would probably give 2 different answers on how they view quality and quantity. And I think the size of the investment bank, the larger the investment bank, certainly the more inventory that they may have, and the more they can be patient on launching deals, and maybe more private equity portfolio companies make up their funnel. So I agree with Ramsey. There's a tidal wave happening at what point. I think the founder-owned businesses I've been sourcing since 2001, and I've yet to see more than a pinprick, maybe half a thumb through the dam to launch all these businesses. A lot of these founders are a lot older now. A lot of them may have been through 2 or 3 cycles. At some point, they have to come out into the market. The younger entrepreneurs that are building their businesses, there are a lot of majority recap opportunities. I would say 3 to 4 of the LOIs that we'll be issuing here in the next couple of weeks, they're all entrepreneurs who want that first majority, first bite of the apple, majority recap to get the second bite of the apple. I think what we see both for add-ons and platforms, regardless of the intermediary, referral is, Ramsey brought it up a couple of times, is there's that bid ask, everybody wants the A price. I think with each day we all wake up, the B owners, the B quote quality owners are closer to that B price for the quality of their asset. Not that it's not a closable transaction, but I see with each day, even within add-ons, that is shrinking. And I think that will obviously get more transactions and having the Deems chart start to continue to track up with regards to just money in motion. For a long time, a lot of our add-ons the last 12 to 18 months were great companies with broken balance sheets. And, at the end of the day, once the queue of E's come in, the spread was just too wide for us, and I'm sure other private equity firms listening, to make it hard for these transactions to get closed. But we have more platform pipeline that we're actively engaged and chasing than we've probably had in 12 or 18 months.
Thanks, Ted. And Ted, would you say that the kinds of deals that you do are consistent with that 2.7 add-on to platform ratio that Nadim showed across the industry, or are you different in
Yeah, I
that
think
respect?
if you look at HKW's portfolio, where the investment thesis was certainly add-ons, I would say we're 2 to 3 per company. Not every company in our portfolio is an add-on thesis. But yeah, I think that's pretty accurate. We have a couple that did 1 or 2 and a couple that did 3 or 4. So if you do the averages out, that's about right.
Okay, and Nadim, I want to turn to you and maybe give you the first crack at the question of how the suddenly new political outlook in the United States could impact the M&A market. So now we have a new candidate on the Democratic side of the presidential election, and Donald Trump, who we've seen in the presidency before on the Republican side. What I won't ask who you think is going to win, but what would be the difference between a Harris administration and a Trump administration for the M&A market?
It's a really good question, David. I will say historically, and that election results, who's in the office, hasn't really had a ton of impact on the private equity and M&A markets in general. This one maybe feels different. I'm getting mixed results. Some of the folks I talk to say that it very well could have an impact. It could slow down deal activity depending on the results, or it could accelerate it. There are certain exceptions. For example, part of the reason 2021 was so strong, I believe it was 2021, was that there was an expectation with Biden coming in that tax rates were going to change, capital gains tax rates were changed. So it was an impetus for a lot of sellers to say, hey man, if this is going to happen, we should try to get this deal done because it's going to change the amount of dollars I'm going to get in real ways. I mean, that tax change never ended up occurring. Nonetheless, it did pull a lot of deals forward and made 2021 even more robust. So there's always elements about election results that could impact or drive private equity and M&A deal volume. I don't think there's a consensus view right now on, whether it's the Democrats to win or the Republicans, which side wins and what the impact could have. But perhaps some of the other panelists have different views on this.
I mean, I'll jump in. I would just add that I agree with Nadim. I think we all get hesitant during elections, especially in the career paths that we're in. What I find, just on a personal note, is when you see a lot of the large brand name founder investors of the largest and most successful private equity funds and venture capital funds publicly acknowledge who they think makes sense. I think that could change the psyche of some of the owners or those considering a transaction, depending on who does win our election. I've not seen as many founders of, again, some of the world's most successful funds come out publicly as they have, and I think that a lot of this is perception reality, and it's a psychology kind of mindset, but I find that interesting.
Okay, well, let's turn to a question that is always popular with attendees, and that is where we're seeing the most deal activity heat up and where we're seeing it cool off. And so we want to hear about industries and subsector trends that are generating deal flow for private equity sponsors. And this time, Steve, how about I start with you?
Yeah, sure. I would say most of the interest that we would see is really in and around services, whether that's business services, healthcare services, industrial services. People are really focused on very capital efficient kind of asset light models. So I think similar to the data that Nadim was showing, a lot of interest in the different various services sectors. I do feel like now that things have stabilized a little bit with interest rates, we are seeing people have a little bit more of an appetite for more heavy industrial and building products type stories. Almost, I think for a while you had to be a real contrarian to want to jump into those things. I think now people are starting to put their toe back in the water, and we're seeing good receptivity with industrial and building products. I think an area that we've been very active in that continues to see a lot of interesting growth and traction is in equipment rental. It's an area that private equity hasn't really been that involved in, though HKW has had some success there over time. We've been sort of very active in that sector, and I think it's one that private equity is starting to get more and more interested in. But I'd say it's pretty across the board. We don't do a lot of the hardcore, AI technology, biotech, kind of earlier stage type things, but I think the interest level from an industry standpoint is pretty broad, I would say.
And Steve, I know you do some healthcare there. Did you experience any of the slowdown that Nadim's data suggested recently in healthcare?
Yeah, most of our healthcare historically has been very oriented around medical devices, manufacturing, distribution, marketing of healthcare devices. I do think, we actually recently added a banker, Josh Mastracci, to lead healthcare services for us. And so we're eager to do more in healthcare services. I do think there's been some kind of political and regulatory pressure on a lot of the roll-ups that have been getting done in healthcare services. I know in talking with Josh, there's some very large buy and build practice management deals that have been out there in the market that the federal government and people have been sort of expressing concern as to whether that's whether those roll-ups are harmful for competition and pricing and outcomes for patients. And so I think I think you're going to continue to see activity in healthcare and healthcare services, but I do think it might shift a little bit away from, let's just roll up a whole bunch of doctors and build a big practice, to the things you used to see where it was all about taking cost out of the system. What could you do to try to get good or better outcomes for patients at a lower cost? And I think that may be something that you see, because the private equity firms really don't like to be in the newspapers or have headline risk, and you are starting to see some of that with the current administration.
Right. Yeah, there's an area that the activity might well depend on the results of the election and whether we get a more deregulatory minded administration or not. All right, Ram, let's turn to you on the same question. Industries heating up and ones that are cooling off.
Yeah, we don't, because of our specialization in really multi-generational family businesses, we tend to focus on those businesses that existed a couple of generations ago. So things like healthcare and SaaS, you don't enter our vocabulary. It's just something we don't do. And so we don't chase industries. Because most of our companies are leaders in niche markets, we're sort of, we look at industry a little differently than most. We don't have that specialization that we can bring to the table. But more importantly, it's really trying to really understand what their business is and what's special and different, unique about it, and then finding that right partner for it. So we're seeing volume come across from family businesses across the board. We love manufacturing, consumer products, business services, but then when you drill it down, what subsector of the subsector of the subsector are we looking at? Right now we're looking at you're talking about manufacturing, then you get into aerospace, then you get into engine parts, and then you get into high specialization, high precision titanium parts. All of a sudden you look at that industry, well, that's a really different one than, let's say, a propeller manufacturer or an MRO, right? So it's a little different from there. We want to make sure that we can find the right partner for that business. And if you look at it, you know what? This is one of the few times I can actually do this. That was the entire equity market in the late 90s, 1999. That was my sponsor coverage list. Yes, it's laminated from a prior firm on Wall Street. And yes, Ted, you are right there.
Thank you.
But that was the entire industry back in the 90s, right? That was it. There's 53 lines on that piece of paper. Right now, there's 6,700 private equity firms that are out there. So each one, you used to make money by financial engineering or by relationships, buying low and selling high. Well, there's lots of smart people in the industry right now, all of whom have that same skill set. So now what's that point of differentiation? What are you going to bring to that table that's going to be different than anybody else? It's no longer leverage. It's no longer financial engineering. It's no longer the basics. You've got to drill down into those real specializations and have a demonstrated excellence in whatever micro organization, whatever micro industry we're looking at. So just because you've done an MRO doesn't mean you're going to be a good guy for my titanium parts company, right? So it gets into another question later about how we built buyers lists, but it really is trying to find that right partner. With that said, back to industries that are great, family businesses are about to explode because of all of what we said before. Get ready for the tidal wave. Ted, keep your powder dry.
Ted, well, Ted, sounds like you've got plenty of dry powder. And Ted, what's a niche sector, totally unsexy, with lots of opportunities that doesn't get talked about? We have already heard about equipment rentals.
I think titanium engine parts for airplane engines would be fantastic. I think we all read about the data centers and AI, and I think the picks and shovels jobs that people, discuss would have been a great answer 3 months ago, whether it's HVAC or other related businesses. But, I think it's some of the boring little companies, but they're not so boring as Ramsey and Steve would communicate as well. I think if you think of just like the infrastructure of the United States, you can get into wastewater, you can get into utility, you can, why are there brownouts in California? All those little manufacturing service, equipment rental businesses that people take for granted until they don't work. And then there's a problem. And I think, especially within the infrastructure of our country, there's oodles and oodles of opportunities. I think if you think from the roll up, we all read stuff, but you can get into certain franchise models that will be stable and predictable through all different cycles. Laundry would be one, for example. We have a business called CMIT that is a managed service provider for small and medium-sized companies. Regardless of the cycle, companies are going to be open and they're going to need their IT to work in cybersecurity, and other things like that. I think there's going to be, facility management. Steve talked about, elderly and the healthcare and the baby boomers. How is all this going to work? These are great business models, and I think there's plenty of sector-focused funds that will target those areas. You get into chemicals, I can go on and on, but it's almost the industries that HKW and many of our competitors, were investing in many, many years ago. And I think, they're still here. There's a tech component to them, how they execute their business, but they're not, quote, necessarily a tech company. And I think, there's certain regulatory industries that can do well too. But everybody wants to swing for the fences. I respect and understand that, but there's still a lot of just basic economy type businesses. We're looking at a lot of onshoring type businesses. We think there would be a big trend on onshoring that fits right up, all of Nadim's data, as well as what Ramsey and Steve and their teammates work on. I think there's, robotics play with regards to making manufacturing more efficient, and in other sectors, that's, again, a lot of old school ways to create those robotics. And yes, there is technology involved. And I think one is just reskilling of our fellow citizens, and how do they evolve their own career paths with regards to AI and all the technology pieces. There's many more. Those are just ones that we discussed internally at our firm.
Yeah, I think Steve said it appropriately, which is that there's a buyer out there for everyone. It's who's got that right theme, who's going to bring that right partnership, who's going to do best with that investment is going to be, at the end of the day, the right partner for the company, no matter what your niche is.
All right, guys, thanks for the helping to navigate opportunities in different industries. And now we're going to turn to the credit markets, at least briefly. And if there's one thing I've learned as a journalist covering private equity for over 25 years, is that the M&A market really lives or dies on the strength of the private credit markets. And Steve, I'll turn to you. We've seen a lot of money pour into private credit. Seems like every day a new private credit firm springs up, or a new joint venture is announced between some big public pension fund and a private credit money manager. What impact is all that money coming in having on the credit market, and how are leverage multiples and terms shaking out as a result?
Yeah, I think the way we think about it is that, obviously the private credit coming into the market is sort of bringing back an ingredient that was missing for a while. I guess when interest rates went up and banks all of a sudden started having worries about commercial real estate exposure and increased regulatory and capital requirements, the traditional commercial banks really sort of all but left the market. As private credit has come in, I'd say they have brought back to the market liquidity to get deals done. I'd say that the market is, the credit market is definitely back. It's still fairly selective. It's very, very specific to what sector. I've even heard people say, it's specific to the sector and it's specific to the deal. So you may talk to one lender that likes a certain sector, but they already have something in that sector, so they don't want something else in the sector. So what we've generally heard from sponsors is that they're going out to a much broader list of firms, and I think what's happening now is they're getting multiple interesting proposals back when they're looking to finance their deals. Whereas maybe 6 or 12 months ago, you might go out to a similar number and get one proposal or zero proposals. So I think the market is back. The private credit market, I think they're very focused on supporting sponsor deals. They're not as interested in doing founder-owned transactions absent a sponsor. So I think that if there was a private business that was looking to go out and just do a refinancing, I think they're going to have a lot harder time. I think the private credit funds like having a sponsor standing behind the deal, that if something goes wrong, they know there's someone there to help. And I think they're underwriting for growth. They're generally doing these deals with the idea that the business is going to grow and margins are going to grow and they're going to get paid out, and the leverage is going to decline from the minute they do their deal. I think the other thing we've seen is that the syndicated credit market is coming back, and I think that's adding a nice competitive element to it, because they're having to be more competitive to try to get the market share back that they've lost to the private credit funds. So I think that the overall message is that it's you can't have private equity transactions occurring if there's not a good liquid credit market out there, and that's all of these funds piling into the market has really brought that back. That in itself is not enough to have a good market, but you can't have a good market without it.
Steve, how big a deal do you have to avail yourself of the syndicated credit market?
I would say probably at least 25 of EBITDA. Maybe even, I don't know, maybe a little below that. But most of the deals that we do tend to be sort of single bank deals. With traditional non-bank lenders like a Monroe or an NXT or someone like that. I think that a lot of the headlines that you've seen about private credit have really been a lot of these very large firms coming in, the Blue Owls of the world that are looking to do deals for companies with 50 or 100 of EBITDA. So I think it's added a lot of liquidity to the market, but I think it's a lot of the traditional non-bank lenders that are still doing most of the deals in our end of the market.
And Steve, on one of the single lender deals, more typical deal, what's a fairly down the fairway leverage ratio now that you could get?
Yeah, I think on most of the things that we're reaching out to folks on, you're back to seeing maybe 3.5 to 4.5 times leverage on deals, and the pricing is usually maybe SOFR plus 550 or 600. We'll see some deals, again, if every deal is specific. So if it's a deal with a lot of high, recurring revenue, high margin, contractual revenue, you could see, something well below that 550, maybe 400 or less, and higher leverage multiples. But, I think it does feel like we're back to the point where you actually have options and you can sort of play lenders against each other to try to get a slightly better deal. Whereas, for the last 6 to 12 to 18 months, it was sort of, you were taking what you could get and you were happy with it.
Okay, that's a great insights into what's going on the credit side. And Ram, I want to turn to you, go back to, well, related question, and that's where have deal valuations kind of settled? Now, it sounds like you're seeing B deals, you're seeing A deals. So give us a sense for, you know, what kinds of multiples those different brands of companies are commanding right now.
Yeah.
Good luck, Ramsey.
What's that? Yeah.
I said,
Not
good luck.
Not high enough, Ted. We need you to bid higher. No, I think I hate the rule of averages, right? Because you can talk about the average of the average of the average, and all of a sudden it mutes the important insights that come out of it. Yeah, we're doing 3 different deals right now. One's an HVAC company that's north of 10 times. We've got we know of another, we're advising the family on an InsurTech deal that's probably going to be in the high teens EBITDA multiple. And we're also looking, we're doing a manufacturing company that's about 7 times, and we're doing a construction, really great construction company that, you know, in the 5 times range. So it comes down to what's the industry specific range you're talking about. It comes down to how much leverage can you put on the business. And I'm so glad, Steve, that you're seeing what we're seeing, which is the debt markets are starting to open up again. Since the September of 22, everyone came back from Nantucket, and then the world shut down for 18 months. Now all of a sudden we're starting to see that come back. So that's really driving some more confidence in the market going forward. As lenders continue to lend, equity folks will continue to bid up, and which will help drive valuations higher. But it's going to come down to, at the end of the day, the company specific dynamics. What about management? What about growth? What about brand? What about sustainability? What about defendability? Do they have a moat? And all of those things get talked into the soup of valuations. So I do expect, generally speaking, so that's a great way to avoid your question, David, but let me try to give you sort of the overarching one. I do think as lenders continue to lend, valuations will start to creep up, but then as deal flow continues to ramp up, the time invested into it is going to, and the availability of incremental deal flow will push valuations back down again. We right now, the valuations have remained really high statistically because there's not a lot of them, right? Despite the volume, I think what we're seeing is still the best companies are out there. What you're not seeing is the companies that didn't trade. What you're not baking into your analysis is those that never came to market. And so as you push volume into it, if only the best deals are happening now, that's the valuation range we're talking about, that has to come down. But what we're seeing on the family side or the founder side is that that's already baked in. They're not trying to time a market. The equity folks are going to be focused on MOIC and IRR, right? And so there's a quantifiable metric there that has to be achieved. Families and founders are really worried about their grandkids, or I don't want to do this anymore, or I had a health scare, or I've been in it too long. I have 2 clients right now. It's just time. I'm done. And so it's really, valuation becomes secondary to the concept of partner. Who's going to be the great steward of my company going forward after this? But so generally speaking, David, as lenders lend, valuations will come up, volume will follow that, which will push it back down. But I don't think you're going to see massive volatility in core markets like manufacturing, business services, consumer. Those have always been studied in the middle market. They always will be. Healthcare, technology, software, those would be much more volatile. And who the hell knows? That I can't speak to.
All right, well, we've heard a great overview of what's going on in the credit markets, as well as what's going on with valuations. And so my question for Ted, the deal sponsor, is, does that make you a buyer in this market, a seller in this market, or where do you stand?
See all the above, I guess. You know, I think, you know, on the exits, or the seller is, I think Steve or Nadim referenced it earlier, with the average portfolio company holds 7 years, and you know, the fiduciary duty you have to your LPs, you've always got to be proactive on how we look to exit those businesses. And you know, we are having discussions with our LPs how to manage some of this, and so I think, yes, I think, and we are, don't forget, all private equity people, and everything's for sale at all times. I say that tongue in cheek, but we've had many instances where strategics have been introduced to us from firms like Steve and Ramsey's, and we've had that transaction, but I think, hey, I'm a sourcing person who's leading HKW, but I think, I go back and think of 2007, 2008, 9, the GFC, why would anybody come to market then? And I think Ramsey said it nicely is, hey, I'm just tired, I'm ready. I can't buy the Boston Bruins or any team. It's just time to move to that next phase of life. And I think that's where, those PE firms that have those institutionalized sourcing programs are able to see those opportunities, whether they're both platform and or add-ons. So, everybody's hunting all the time. And I think firms are always looking for opportunities, and it's how do they execute within the current environment that they're, participating in to figure out how to make that work.
Okay, Ted, thank you for that. And we've got about 15 minutes left in the program, so I want to do a final call for questions. You can ask them through the question feature of your control panel. Just let me know what the question is, who you'd like it directed at. And in the meantime, I want to ask Nadim about some of the technology advancements that we've seen recently, especially in artificial intelligence, and what impact are those having on the ability of firms to source deals, make more short lists, and generally do a better job of sourcing transactions?
Yeah, sure, David. One of my quotes when it comes to how to view AI, certainly as a CEO and strategically leading an organization, is that the best way to predict the future is to invent it. So, advances in technology, generative AI specifically, are shaping and going to reshape the industry, the world, so on and so forth. How it's going to do that is very much going to be determined by us. How we try to figure it out. There's no playbook for it. And certainly we're not in the business of advising our private equity, firms and clients on how to best use AI for their businesses or their portfolio companies. We leave that to our parent Bain and other consultants and experts out there. What I'm doing, we specialize in deal sourcing and business development. We're a data resource tool. As a data tool, we are prime for generative AI to analyze that data faster, make it easier for our clients to glean insights from that data, get direction. So there's two things we're doing. We are exploring how and have adopted certain AI augmented resources and processes to help improve our data collection process. Not only to make it more efficient, but to make it more comprehensive. So that's on the one side of our business, which ultimately will benefit our clients. And we're also exploring how on the user side, enhancing our user experience with, like I said, using this to analyze the data, the thousands and thousands of rows of information and, I don't know, maybe 1 million fields of information, to use AI augmentation to help our clients just analyze and think of ways to analyze and insight data so much faster than they could from like traditional means. So certainly that's how we're thinking about it. And it's really, it's kind of like the wildcat days of oil and gas. There is no playbook. You have to figure things out. You have to educate yourself. You have to stay informed, and you just have to try things out. And I think the leaders and CEOs of organizations that are doing that and are willing to invest the time to figure that out are going to be rewarded, and then their clients will be rewarded as well.
Okay, thank you, Nadim, for that. And we're going to turn now to some of the nuts and bolts of deal sourcing and take advantage of the fact that we have one of the best deal originators out there, and Ted Kramer. And this question came from the audience. Ted, what cadence of outreach to sell-side investment bankers do you find to be most effective?
Fair question. I think a lot. I think it depends on, you know, the size of the fund and how fragmented the deal flow is, for one. I think it's a blend of using all the metrics of SPS and Nadim's efforts and how to position yourself or meet new contacts or remind people of your investment criteria. I think it depends on the size of the fund. I think for a small fund like HKW, where, you know, probably 75 to 80% of our closings come from what I would term secondary and tertiary markets, like Indianapolis, Kansas City, cities like that. I think that emails and Zoom calls and everything are great, but hey, at the end of the day, if a small intermediary is only going to close 2 or 3 deals a year, you still need to build that authentic, genuine relationship to get the benefit of the doubt. I think, how do you get the benefit of the doubt? All things else equal, whether it's larger firms, medium firms, or smaller firms, it's doing what you say. I mean, it has nothing to do with technology. It's, hey, you do what you say you're going to do. You firm and conduct yourself with high integrity, and you care about the relationship. And I think that's very important. The larger firms who've got sponsor coverage people and more institutionalized, do Steve and I need to talk every other month? Yeah, probably, but it's more of a blended conversation of where are our companies, where can TM be helpful with ours, and what is the pipeline? I think when you get into firms, 1 or 2 people, you've got to constantly be in front of them or you'll be forgotten. I think Ramsey said there's 6,700 firms out there. I can only imagine how Ramsey and his firm try to figure out of the 6,700 who has the hat and the cattle versus all hat and no cattle, if that makes sense. And it's hard because they need to look good for their client. They need to bring the right parties in. And ultimately, you're going to select people that you trust and have a high closing rate. And I don't think technology and this, that, and the other can do that. I really don't. The larger firms where you've got more finite deal flow and you typically know the 5, 10, 20 firms, I would give a different answer. But I think in the small end of the middle market, it's so fragmented. You got to build genuine relationships if you want to, you know, see their opportunities, or all things else equal, you know, have the chance to lock the transaction up. What I do find is different private equity firms have a myriad of budgets that either allow or don't allow their professionals to do this. And that's a whole nother conversation. But again, I think the human element in the shoe leather means a lot for a cadence.
Okay, Ted, good insights into the deal sourcing process there. And Ram, you dramatically brought home earlier the growth in the number of private equity firms out there, from your laminated list of 53 to more than 6,700 today. So how do you put together those short lists, and how do you know, sponsors make sure that they don't miss a great Ramsey Goodrich deal?
Yeah, thanks. And Ted, I think you're absolutely right. The one of the main criteria is, do we know you? Do we like you? Do we trust you? At the end of the day, I'm taking my client and putting him in the hands of Ted or somebody else. And so, yeah, there has to be the final overlay is a personal relationship. So reaching out and touching it and being involved is really important. We might do a little different than Steve, because I don't have a sponsor coverage group, right? And so our deal lists tend to start with a Capital IQ, a pitch book, and an SPS download. And try to figure out, okay, this is the universe of relevant buyers. We might start with 250 potential names. We also leverage the client. By the way, Ted's not just calling me and Steve. He's calling on, or the private equity guys are calling all the companies directly. And every company we work with has a paper file that's massive of all the emails and the letters that they get from outreaches, whether it be buy side or direct or indirect or ideas. So we start by looking at our own database research, and then the list from the clients. The clients tend to know who would be a good partner here after all. We whittle that down. Our processes are really going to be more in that 50, 60, 70 names only. We don't believe in really broad auction processes. And so at that point, because there's 6,700 private equity funds and thousands of potential strategics, the database is full of names, we're looking at excuses to get rid of folks off of our buyer lists. And so really you have to have a rationale to do that. One of the other ways, going back to what Ted was saying, one of the most effective ways to get in front of me is email. I have a file in my email folder, which is private equity profiles, and I keep a running list. If I get a good email from a private equity fund that says, hey, this is my portfolio company, this is our expertise, this is the value we have, and this is what I want to do with it, I will save that file and refer to it. Every deal list that I build, I go back to that email file and say, who has relevant experience in this space, and who's got the portfolio of people or a theme that's going on. Please, and I'm going to make the recommendation to all the guys out there right now, don't send me the list that says, I'm looking for an EBITDA positive thing in North America. I can't help you with that. I have no reason to call you with that. Stop sending me those emails. But if you send me an email saying this portfolio, this is our investment thesis, this is my research behind it, this is why we're really excited about it, you're going to be highest on my list, no question about it.
Yeah, I would echo that, Ramsey. Hey, just send us all of your deals and we'll let you know which ones are a good fit for us. That's also not helpful.
No, the biz dev kids all want to pad their stats, and I get that. It's part of the game. It's all fine, but stop. Send me your thesis. We did a deal a couple of years ago with a private equity fund that we rejected them because they didn't have anything on their website. We didn't know of any themes that they were doing, and yet they had hired a buy side person to go help develop that theme and find particular targets. We talked to that buy side guy. He said, you know, this is going to sound weird, but I'm doing a buy side search for a private equity fund that's not on your list that has this theme. In the end, they were the right guys. They had the theme, they had all the research, they were excited about it. We would have never have known, and we had already rejected them off of our list. So be communicative about your themes and your investment theories and what portfolio companies are looking for. Not EBITDA positive in North America, right? I got to get more granular. Not the MRO, but the titanium parts guy, right? The more specific you can be, I save those files, we all do, and that helps us make a really targeted list.
Good answer, Ramsey.
Super, yeah, super job there. And we've got 2 minutes left. So I'm just going to make a call here as the moderator. I want to hear 1 minute from Ted on a under the radar portfolio company that he's just super excited about right now. And then we'll give Nadim the final word. Ted?
Oh man, that's a loaded question. All of them. I'm excited about every company in our portfolio. No, I think, you know, without naming them, I think there's companies, some of the best companies are the ones you're most rooting for, those that have gone through a tough experience. So I think some of the companies that came out that, hey, today I would approve these as our IC, rather, not just me, but our IC would approve these companies that went into COVID and then struggled. And to watch the resiliency and the dedication of management teams to right that ship is really exciting sitting here today watching the momentum that they've been building. I think that's a great story. And fun to watch. We may not get a 5x return, but we certainly will make a return. But I think it's the excitement of the commitment of the management teams, you know, that makes my heart warm. Do we have companies that are way ahead of plan and way ahead of thesis, and we're all giddy about it because it's working out so well? Yes. But for me, many times it's those when it doesn't go as perfect as it should, and to watch them still win at the end of the day. Maybe that's a cop-out answer, but that's where my mind went to once I heard the question.
Yeah, that actually, that's kind of reminds us all why we're here. And Nadim, I'll give you the final word on the program.
Well, if that question was kind of like asking which child you love the most, but I would say it's been truly a pleasure working with Ted and watching him grow. HKW is a client. We value the relationship. It's been great, but probably known started pitching our product to Ted. I don't know if you remember, it was like 12, 13 years ago. And I was, just eager entrepreneur, naive, trying to figure things out. And we probably had some, not probably, I distinctly recall some pretty heated conversations early on when I was trying to convince Ted that he needs to use our product. And I appreciate him keeping an open mind and partnering with us for a long, long time now. And not just, and then him professionally going from a BD professional, which I was a BD professional for a private equity firm before starting the company, to being president of his firm. So I will, I'm not going to say he's my favorite client, but it's been a pleasure working with him and watching him grow over the years.
Thanks, Nadim. Well, that's a nice compliment. I wasn't expecting that from the panel today. I got paid more. Where are my exits? And Nadim, thank you. I remember those days. I remember those days fondly.
Okay, good. I'm glad we both remember them. That's good.
Pension's the only way to get better sometimes in my book. Maybe it's the athlete in me, but I appreciate your comments.
All right, well, with those good feelings percolating, we're going to call it a program. And thank you everyone who came. Thank you to SBS by Bain & Company for underwriting the program and making it possible. And thank you so much to our speakers for doing a great job in preparation. Nadim Malik, SBS by Bain & Company, Steve Hunter of TM Capital, Ram Goodrich of Carter Morrison Goodrich, and Ted Kramer of HKW. Thanks, everyone. Have a great rest of your day.
Thank you, David.
Thanks, everyone.
Thanks, David.
Bye.
Thanks.
Thank you.
Yeah, well done, David. And Nadim, thanks.